live on YouTube. I'll make sure I don't double hear everything. Okay, we are live. Okay, good morning, everyone, and welcome to another episode of the Crypto Hour. This is the 12th of May, 2023. And if you have been following the market this week, there's been a little bit of a reaction yesterday to the producer price inflation in the US. And we go and have a look straight away. Okay. Let me share. Okay, first of all, let me just go and have a quick look. This is the S&P 500. Okay, so looking at this chart, this is the daily chart. So it covers a period that goes from, from today to, October of 2021. Now, so that I know that many of you are into investing and looking at the markets every day. So what can you tell me what's happened in the recent history, at least going back to kind of the middle of last year? Can anybody tell me? And this is just like
dip, and now that's come back, and then it's now going sideways.
Exactly that, Kim. So if we look at what's happened since whatever August of last year, is because it kind of like it's called like the box of doom in trading, in the sense that it's just been kind of like trading sideways, going up, going down, going up, going down, but with no clear direction. And now, what we tend to do when there is, as investors, as traders, basically we want to go with the trend, whatever you call it, with the momentum, because you want to know where the market is going, so you can go in the same direction. And what happens that when you don't know, when you can't tell, because at the moment, I wish, if you can tell me what the market is going to do next, then please go ahead, because not many people actually know where we're going next. So what we need to do to to get more clarity about a situation is kind of like zoom out, and this is in any sort of market. So if you're looking in any time frame and you're having trouble understanding what is going on, just zoom out, get yourself out and get more clarity on the situation. So we're going from a daily to a kind of a weekly chart. You remember when the last financial crisis was? Come on, guys, these are not trick questions.
2019.
2007, 2008. Okay, so let's go and have a look. So this is this period here, roughly. Okay. Okay. Because that brings us into what we're talking about today. So the crisis started in 2007. Okay, so as you can see, the market was still going up. And do you know, as the market was going up, do you remember what were the credit situation, the credit conditions during this period? For those of you that can remember that far.
They were handing out credit to really high-risk people. Was all the subprime stuff in the U.S.
Yeah, no, this is historical. What you're talking about, Kim, is historical. So it's been going on for a long time. But actually, I'm talking about these few months between 2007 and 2008. This is when the Fed was raising interest rates. Okay, so they were tightening and still raising interest rates. The market was still going up. Okay, until we got towards the end of 2007. And do you know what happened then? Before this big drop, is when the the Fed paused its interest rate hiking cycles and started cutting interest rates. So all this drop was during the interest rate reduction. Okay, so I want to kind of so to make you understand kind of what list, because we don't know what's what might be happening in the next few months, but this is what happened in the past. At least we can see what happened in the past. Okay, so this is the result of the tightening of let's say willingness to lend. Okay, so this is a statistic by the St. Louis Fed. Okay, so and this is by investigating, asking Federal Reserve Board senior loan officers. It's a survey. So if you can see, so these peaks here is when they were kind of like above zero, is when they were unwilling to lend. Okay, so basically they thought that there was too much credit in the market, they started tightening, and so lending out was not as easy. Borrowing, if you had been a consumer in those periods, you would have found it more difficult to get credit, to get mortgages, and so on. Okay, and what can we see? And so this goes from 1967, so it's more than 50 years of history. I mean, it stops. This one stops in 91, but you can get the idea. So every time there was like tightening of the willingness to lend, so tightening of the credit, okay, this is followed by these gray areas are recessions. Okay, so every single time, that there has been this tightening of the money cycle, it has been followed by a recession. This is why a lot of people are kind of expecting a recession. If you don't believe that we already are in recession, as I do, really. This is what will generally follow a period of expansion, which is these periods here is when the market is growing because there's more money in the market. Okay, so this finds its way to to commodities, to stocks and shares, and anything that is is considered more risky than government bonds, etc., etc. So the other statistic that it's interesting to understand is this one. This is from the Institute of International Finance. Now the blue area is so this whole graph is credit. Okay, so credit is not just the banking sector, but from many other sources as well. So if you can see, pretty much the banking sector share of the credit market has slightly declined, but it's pretty much became quite steady. And what can you say by looking at this graph compared to 1976 to our present day? What do you think? Which color do you think has got a lot bigger?
Well, the government-sponsored enterprises. Exactly
that. So what is happening and what has been happening, and maybe this is one of the graphs that better illustrates the difference between the Keynesian system and the Austrian School of Economics. Okay, and what the Austrian School of Economics main point is that by somebody, not the market, but somebody making a decision on where to allocate resources, these resources get misplaced, get used. I'm not saying that there's anybody stealing or anything, but these resources get put in the wrong place and they're not as efficient as if the market was deciding where to place the resources, where to invest, etc., etc. And this process, according to the Austrian School of Economics, is also cumulative. As you can see here, the government and government-sponsored entities have become a larger and larger and larger percentage of the economy. Okay, as you can see now, is close to the size of the banking sector in terms of how much credit it is lending out. So what you realize sometimes what we've seen, and you might have seen, Roger often talks about thinking we're going from the 2008 was a moving from consumer lending problem to then how did we solve the 2008 problem? It just has gone from, they probably gone from consumers to enterprises. What we're seeing later is that it's gone from enterprises to countries. Okay. And what would be the next step? Where has it got to go from there? Because at the moment, so basically the risk has moved from the private sector to the public sector, because there's nobody that could take on that elevated amount of risk. There's no private enterprise that could withstand that elevated amount of risk. So, you know, and this is where, again, if you look at fiat currency systems in the past, this is what happens before they collapse. Because, you know, there's always somebody that steps in and says, look, don't worry, I'll sort this out. Don't worry, I'll sort this out. And that goes higher and higher and higher until there's, you know, there is no higher it can go. Okay, and this is you know what we've been talking about last week and in the past couple of weeks. We said that, you know, the increased economic activity depends from productivity of labor and productivity of capital. Okay, so first of all, you know, and this is kind of, I want to bring an article. This is regards the UK, where the pension age was already risen from 65 to 67 recently, and it's already been decided that it will rise to 68, because, guys, I mean, these are the pensions are being paid by people that work, and as the older people that actually draw the pension are getting more and more you know, numerous, then you know, something has got to give, because you know, the population is getting older, and you know, the people that are working are getting less, as we were talking about last week. So and this is for many of you live in countries that are regulating or trying to stop immigration very heavily, whether it's Australia, whether it's the UK or other countries. And this is, for me, is the most idiotic policy that you can possibly imagine. Okay, because the only thing that can move an economy forward is a demographic increase, to increase in population. Because with the system that we have, the capital efficiency has been getting less and less and less. So the success, the countries that will have success in the next decades are the ones that can use demographics to their advantage. Okay, so restricting immigration is basically kicking yourself in the teeth. Okay, and this is what happened in the UK, for example, with Brexit. You know, that's pushed away many either seasonal or permanent immigrants, and now they're in a situation where they can't get many things done because there aren't enough people filling the jobs that are required. Okay, and so that is, for example, the main reason why the UK inflation is higher than the American inflation, the European inflation, the inflation anywhere else in the world, at least of the industrialized countries, because they have got these drivers that keep pushing inflation up that they can't deal with because of the policy they have adopted. So all these things are important, and it's important to understand what these policies, what these policies do in the long term, because in the short term, you know, all politicians care about is getting re-elected. And why do you think this pension age rise is delayed until after the election? Because it's political suicide to do that. So everybody think, well, if it's us that has to do this, at least, you know, we'll have another 4 years in power. 4 or 5 years in power. If it's somebody else, then they're going to get in the neck, because they're the ones that have raised the pension age, not us. So this is the problem with most of Western countries. Okay, the exception being maybe Japan, where they actually do take, you know, they have long-term economic plans, but no other Western country has any long-term plans economic. They're all like very, very narrow, and only you know, pointed at getting re-elected in the next cycle. Okay, but so this is wanted to share you, because what's my view of where we are right now. Okay, this is the psychology of a market cycle. Okay, so it goes from, as you can see, optimism, belief, thrill, euphoria, and then complacency, anxiety, denial, panic, capitulation, anger, and then we start all over again. Okay, so this is the disbelief. That's kind of where we started from on the left. Now, question: where do you think we are right now in this cycle?
On anger.
Anger.
Complacency.
Sorry, complacency. Yeah. And who said complacency?
Me, Archie.
Archie, very well done. We are exactly here now, right now. Okay, so, and this is kind of like many people actually don't see what is the most. I'm not saying there's no security here. There's no making sure of what's going to happen next, but we're talking about probability all the time, and kind of these cycles tend to repeat over time. Okay, and generally speaking, this is where a lot of people see that we are right now. Kind of like we kind of like, oh yes, we had a little drop, now we are recovering, let's see when we can pick up again. But the thing to understand is that these things, these drops have always happened after the kind of the interest rate hiking cycle has finished and is paused. So going back to the S&P 500, you're going back to the weekly chart. So let's have a look at what happened in 2007, 2008, and where could be comparably could be right now. So this is going from the market top. We had a drop of about 25%, yeah, and then we have a kind of like a bounce of, where are we? Oh, come on. We had a bounce of about 15%, a bit more than 15. Where are we? Come on, good, 15%. Okay, so we had a 25% drop, a bounce of 15%, and then who wants to know from that bounce, how much did we drop? Drum roll, drum roll. Okay, 50%, 53%. Okay, so I don't want to scare you, but something of this magnitude, so don't write down 53.45% because this is not going to happen next, but just to give you an idea of what similar periods have brought to the market in the past. So let's have a look at where we are right at the moment. Okay, in a box of doom. Okay, I'll make it a little bit bigger, so let me take this off. So if we go, this was the top of the market in January last year. We've had a 27% drop. Okay, so we saw 2008 was 25%. Then from here, we had a 20% actually bounce. Okay, so if we have to do anything close to what we had before, where would that take us? Let me just make this slightly smaller, because otherwise, I'm sorry, I need to make it smaller because otherwise you can't see where we would be getting. Go from the bounce. It will take us, below the pandemic low. That would be, or pretty much around the same, maybe a little bit lower. So the pandemic low would be pretty much a 48% drop from now. And then, I mean, strictly speaking, this is the first. This drop here is not an economic drop. Okay, this is a market panicking because of the pandemic. So it's not necessarily due on any financial crisis. This is the first crisis we actually are confronting ever since, you know, the 2008 crisis. Okay, so this is to be compared to that one, but this is not. This is almost like you know, in the long-term charts, it would be like a blip. You don't think, you know, this is what happened in 2020, but it just lasted a few months. You know, it went from, you know, this is February when it started, and by August we'd already recovered everything. Where the 2008 crisis, you know, it was so February. Whereas that the low was February 2009, so it took quite a while to drop actually from October 2007. So it's about a year and a half it took to. And when did we get back to the levels to the higher? Is 2013. So we're talking about 4 years to actually recover and be at those levels. So what I'm saying, this is not, you know, it's not all doom and gloom, but you have to be ready. You know, if you have funds invested and many at the moment, many investing circles are staying dry, so to speak. So with a high level of cash and a low level of committed funds, because they kind of like you know, whenever there is a period like this that we're seeing sideways, is because people are waiting for a direction, because it's very difficult to just guess and double guess the market. Normally you end up hurting yourself when you try to do that. But you know, it's kind of we're waiting for the market to show us direction, whether it's on the way up or on the way down. You know, I would, you know, if I would say the balance of probability, I'll tell you that the next move is going to be sharply down. But you know, I might be wrong, as I have been before. That wouldn't be the first time. Now, so this is what, and this is the reason also why we've been talking about macroeconomic thing. This is a crypto hour, but I've been talking about macroeconomics for the last couple of months because we're not going anywhere. You know, neither this nor any of the other market like Bitcoin or crypto or something like this. You can see they will have a similar waiting patterns, because we've had a crazy growth from 2020 to now. This is kind of like it's doubled, more than doubled the market in just over 2 years, which is insane. You know, even if we calculate from the top of the market in 2020 to the top of the market in 2022, it's still 42%. I mean, this is kind of like, you know, unprecedented growth, and this is all due to the to the money pumping, so I call it money pumping in the market. So like creating and generating new cash everywhere in the world, not just in in the US, but everywhere else in the world as well. So at the moment, everybody think, well, we've had our fun. What's going to happen next? Are we going to pay for it, or is somebody else going to pay for it? Because if the markets go higher, it doesn't mean that the problems are disappeared. It just means that we kick the can down the road. And politically, what's going on right now that you must have heard in the news is that the US government is again, for the, I don't know how many times, I think it's 78 times, you know, is running out of cash. So they are now discussing raising the debt ceiling again. Okay, so that they can do what? Spend more money, you know. So depending on how much of this cash is generating, you know, how much a debt ceiling is raised, that they could try to solve this problem as they've always done in the past, like creating more money, creating more debt, creating more credit, you know. And this is not like, we still, even if we've seen all this growth, we haven't resolved the structural problems that we've had in 2008. We just push them on to our children. That's all that's happened. Okay, during all this period, this 14 years, this is like now the payback for all the things that were caused, all the credit insanity that was called before 2008, before these periods. Yeah. So it just that things were not solved then, and are coming to, somebody's coming on the door and thinking, well, what about now? Shall we do it or not? Shall we get going or not? Now, what also has that meant from the point of view of crypto? I was talking to you before about Bitcoin. We'll go back to maybe a 4-hour chart. I was talking to you before. We were in a sideways pattern from mid-March that kind of like matched this pattern here from May, June of last year. And we actually now have, sorry, what am I doing? We have naturally broken down. So there has been, for the first time since the 15th of March, now there has been kind of like a dip outside of this pattern, and this dip is on the way down. So now again, we're talking about balance of probability. This is for the same reason, because we see a sideways pattern in in the stock markets, because if we see a 50% drop in the stock market prices, crypto will not be immune. It will not be immune to that. So it will affect crypto as well. Now, recently, what we've seen that Bitcoin has fared better in this market than other cryptocurrencies, because is the one they seen more widely as a kind of like solution, or for people that want to be safe with their value away from the traditional banking system. We're seeing kind of like you can read the news every day of, as we discussed here last month, regional banks going down. I told you that was the next thing, the next problem that hit the market. Regional banks in the US and the commercial property sector in the US, and this is it in the war right now. Okay, so there have been several banks going down, several more will go down. We'll see if this then will end up in a really wide contagion like it did in 2008, or if what the Fed is doing, trying to kind of like calm everybody, saying we guarantee all deposits, etc., if that will calm the market enough to stop it collapsing. But from a technical point of view, now that we have broken this pattern on the way down, again, anything could happen, and we'll see if there is anything in the news, today in the next few days that could change this. But the most likely place for it to go next is this range. Okay, we're talking between 25 and 20. Really, Bitcoin moves in $4,000 to $5,000 ranges. Okay, we're going from this range down here to this range up here to this range up here. So we've been in a upward direction since beginning of the year. But now with all this fear and uncertainty, we might see a drop into a lower range. Now, why is that? First of all, because there is a lot of fear in the market right now, and there are also a lot of fear related to the US intervention against crypto. Okay, and I talked about before. If you don't know what I'm talking about, just go and have a listen to the last couple of crypto hours, and you realize what it is that we're talking about. And this is how it's manifesting. Okay, the actual trading volume in crypto is gone down to, it's the lowest since 2021, because people don't have any certainties about what is going to go on. Are they going to be allowed to have cryptos in the US, for example, or not? Are they going to look like criminals if they have cryptocurrencies on in their accounts and so on? So this is the reality, and although we don't, we all say, yes, let's move away from centralized exchanges, let's go into decentralized exchanges. But this slowdown in trading volume is affecting everyone, centralized and decentralized exchanges alike. Okay, so it means that there is less interest or less people willing to commit to cryptocurrencies at the moment than there were a few months ago. As simple as that. Now, there are some, I've told you before last week and the last couple of weeks how the SEC and the banking industry are basically colluding to debank the crypto sector. And by refusing to give direct rules on how crypto companies should and cryptocurrencies should behave, they are making it impossible for anybody to comply with anything because there's nothing to comply with. Okay, so what's happening right now is that Coinbase has issued a what is called a narrow lawsuit against the SEC. It's specific, and this is kind of like interesting because they haven't issued a lawsuit against anything in particular, but they issued a lawsuit to force the SEC to issue some guidance, some rules, because they've written to the SEC in 2022, requesting clarity, and the SEC is refusing to give any indication of what the rules should be. Okay, so this court filing would tend to force them to respond and to have some clarity on what they think about certain things. For example, this is interesting. You're saying, Ether has been around for about 10 years. It's got over 200 billion of market capitalization, and yet they still cannot agree on what it is. If it is a security, if it's not, if it's a commodity. So I mean, this is not helping the whole industry, and he's pushing a lot of, especially staking services and a lot of very, very lucrative businesses away from the US into other jurisdictions. So on another thing in crypto, and this is now, I brought this up because we're getting to the point now where the SEC and the banking regulators are exceeding their powers. So they are infringing on powers that belong to the legislators. So now some of the legislators now, and we are going towards a new election in the US. Okay, so obviously the legislators again, senators and congressmen are now realizing this is going to be part of, people are going to listen to what they do or what they say about cryptocurrency, because whether they like it or not, a large number of population, is interested in cryptocurrencies. Okay, so this is very interesting. The Texas House of Representatives now is wanting to pass a new amendment extending the Bill of Rights to crypto assets. So this is what the new provisions will be. Okay, so the right of the people to own, hold, and use and mutually agree upon medium of exchange, including cash, coin, bullion, digital currency, or scrip, when trading and contracting for goods and services shall not be infringed. Okay, no government shall prohibit or encumber ownership or holding of any form or any amount of money or other currency. Okay, so that would put the rights of people to hold and use cryptocurrency into their constitution, at least for Texas. This is still another vote to pass in the House of Representatives, and then it will go to the Texas Senate. But so these are kind of legislators fighting back and saying, actually, we are going to decide what is right and what is wrong, because we are the ones that have been elected with that mandate. And the regulators is there to apply their laws, not the other way around. Okay, at the moment, what is being forced by both the banking regulators and the SEC is enforcement by guidance. So they're not writing anything down, they're just suggesting things, okay, that to third parties on how to behave. It is not part of the remit, part of the mandate. So this is a really constitutional issues where, when I was showing you this graph here, this is by stealth. Basically, the state is becoming larger and larger, and they're not happy to just regulate, and now they want to direct. Okay, and one thing is that if there is an elected official that you can, argue against. If you don't like what they do, you don't re-elect them the next time. But what about if they're not elected representatives? Here we're going into, are we going towards becoming like China, where you got people in power that you can't, you can boot out and they decide pretty much what you do? This is not, I mean, the funny thing is this, I mean, how many of you have read Animal Farm? Yeah? I mean, this is what we're talking about. This is what we're talking about. And it seems to me, when you read about these things and, books like Animal Farm, like Big Brother, were written a long time ago. Okay. But the thing is that you can see the currents, you can see what, it might happen if we don't do something about it. And these things are actually becoming a reality. And the idea of, central bank digital currencies and some of the other things that are going on like this are just going towards that way, because a central bank digital currency, if used widely, means that every single transaction that you take is recorded, can be accessed if needed. I don't know if something that you be happy with, and a lot of people think, well, if you got nothing to hide, then what is the problem? But the problem is that if you know anything about statistics, you will know the statistics can be pulled any which way you like to prove your point a lot of the time. And would you want all your records being available to somebody that has to make a decision against you, for example, and use some of those numbers against you? I mean, not that many people have got things to hide, but at the same time, it's knowing who would access that kind of information that is the worry. It's not so much, if there is anything to hide. It's more like, we
Luca,
want to know what
they made some changes here in New Zealand like last year about some of the banking requirements, and they were trying to, in the whole thing was trying to help the people that were kind of getting, used by loan sharks. The only problem is that it got so tight that the banks got so freaking anal that people were getting turned down because they were looking at their disposable income. Well, it's my disposable income. I should be able to, spend it as I like. And they're saying, well, you're going and buying coffee every week or every day, and you shouldn't be doing that if you have a mortgage. So I'm just saying they're going to take that to the nth degree. So, even though if you don't have anything to hide and you're doing your thing, somebody's going to make your life, basically suck, and you can't do anything because they determined that you're not spending things the way they thought they should.
Exactly that. And this is that. So the next step of this is the social credits. Is social credits that to encourage good behavior on this, good behavior on that. And this is again, we get into the point of like Big Brother looking at everything you do. I mean, I don't want to live in that kind of world. And I want to have some of my rights enshrined in law, knowing that there are, nobody can do things that without my knowledge, for example. And I say, all of you, go and have a look at if you don't believe me, go and have a look at your credit file, which is free. Okay, and see what kind of information is in your credit file that anybody that does a query can get access to. Okay, so that's the thing we're talking about. Anyway, let's move on. This is another issue again, talking about the SEC again. First of all, the SEC pretty much is refusing to answer direct questions from the House of Representatives Financial Services Committee. Okay, so to the point where it is now, they are kind of like almost like formally at loggerheads, and they're going to get Gary Gensler again to to be interviewed formally by the committee. So this is now, you see, they're going to the point now where the legislature are realizing that there is somebody that is attacking their power, and nobody likes that. Okay, so in a way, it is a good thing, because as we're going towards a re-election, and crypto is going to become one of the big things of the election. I'm not saying it's going to be the main one, but it is going to be important. And if we have a committed group of people that vote on one, the kind of like single issue voters, then the legislators will take note of that, because it make a lot of them are elected with a very small majority. So it will make a difference to, if they get elected or not. So that's, in this, carrying on this thing, then this is there is a watchdog, it's called Empower, that's now requested again, has filed a Freedom of Information request to see what conflict of interest were in the SEC, before they made certain, they talked about certain things. So, for example, when in 2018, they said that the Ethereum network and its decentralized structure, current offers and sales of Ether are not security transactions. Do they own any Ethereum, or did they have any interest of directing things in a certain way? Because after they finished their role at the SEC, they went to work, for a cryptocurrency company that would have a big or investment fund or hedge fund that would benefit immensely from Ethereum being declared not a security, or filing a lawsuit against Ripple, against which was one of the main Ethereum rivals. Is this all above board, or was it done with some personal interest in play? Okay, so there's all these things now. They are coming to, they're floating up because, and for the main reason is that the SEC is appearing like really, really intransigent in all of this, and not, their behavior, you'll say, is not normal. Okay, and so people are starting looking at thinking, well, why is that? What they got to hide in a way? Why don't they want to provide a guidance for the crypto industry? Why are the debunking, even legitimate companies like Messari, that does nothing to do with crypto, they just do reporting. They study and do reporting on cryptocurrency. Why are they being denied a bank account? Why are directors of companies connected to crypto having their personal bank account closed? This is guys, it's becoming quite serious. It's not a joke anymore. Okay, so this is all just to put things into context and to tell you why then we're seeing these kind of like these drops that we see before. Part of it is related to the economy, part is related to crypto issues themselves, but the result is not pretty right now. So we'll see what happens. I mean, the good thing is that as an asset, Bitcoin has held better than comparable assets, at least in 2023. But having said that, this is after we had a massive drop in 2022, so we can be too jumping into this all of a sudden. And going back to the psychology of the market, so crypto, we're still very positive about cryptocurrencies for the future. Okay, now this is not the time, though, as I've been saying to you before, it is not the time to first of all to go all in cryptocurrency. So if you've got your funds that you allocated to this, and kind of like what I tend to do at the moment, 50% in and 50% out. Okay, in the sense that I have a good reserve of cash that can be invested in the market if we do have a drop like this, because the prices, if this happens, we're going to be really rock bottom, and it'll be incredible. Will offer an incredible opportunity, but at the same time, we want to be in the market in case there is a kind of a flight to safety and Bitcoin all of a sudden just jumps up because the banking sector is collapsing or something like this. So we want to have a foot in both camps, in a way. And this is what I'm doing. This is not financial advice, guys. You make your own decisions. But I'm telling you, this is kind of like a you need to, at the moment when there is uncertainty in the market, you have to be ready for every eventuality. Okay, so be nimble and be ready to move. Okay, now I just wanted to bring Jonathan in to speak a little bit about Hydra, because we had, you know, a nice, for the first time, Cardano has actually has released the Hydra, the first Hydra node on the main network. So, Jonathan, could you please tell us all what it means and what the hell is Hydra? What does it do? You're muted. You're muted.
There we go. Sorry, technicals. So yeah, Hydra is a what you'll best know as sidechains. So if you imagine you have Ethereum or Polkadot, you have smaller pockets of functionality built on the side of these main layer 1 protocols that do a whole load of complex calculations much faster, much cheaper than the main chain. And so in the case of Hydra, you've got that similar setup where you have your layer 1, where all Cardano transactions happen as we know it. And that's the authority for the transactions that we carry out. Then you now have the ability to spin up a Hydra head, which is as trustworthy in terms of its finality and accuracy of data as the main chain itself. But it sits on independent infrastructure and can run its own calculations. And the way that they maintain that consistency and that trustworthiness is that the Hydra head will start and end having produced a certain state, and that will go back to the main chain where it'll be verified and consensus a whole Cardano blockchain. So it's a bit like if you're running a banking infrastructure, you go to the bank, take some cash out, go down to the market, do all your trades in your fish market and fruit veg market in the weekend. Then you come back with your pile of cash to the bank and say, I want to put this back into my bank account so I can spend it on my credit card. It's a bit like that. The cash is spun around on a whole load of different things in the fruit and veg markets. And then it's come back to the main chain, the banking industry, where you can then use it in your credit card. And it's a similar sort of thing. Now, the speed of the transactions that happen in the fruit and veg market and the way that they happen can be built and designed in any way that you want. So you can imagine new technology being built on a Hydra head that is, say, an auction house. So you could say, well, we are going to pay for the transactions as it goes from main chain, from layer 1 to the Hydra head with £100, and that's what this is going to pay for our transactions to verify everything we've done back onto the main chain. Then in the new Hydra head, we're going to do all our auction activity with 0.00001 cents transaction fees. So it's ridiculously cheap, effectively free. And we're going to run everything on a really rapid mechanism. So it's just going to run 100 times the speed of the transactions on the main chain. So on the main chain, you get a block produced every 20 seconds. In the side chain, you might decide we're going to run one every half a second. And so you can spin up all these transactions, do all this activity, and then go back to the main chain with your final state and say, we're going to pay for those transactions. And this is the data we took in, this is the data we're handing back. And that's going to cost us 1 transaction fee or 50 transaction fees, depending on how complex the operating parameters of your Hydra head are. And so this gives the industry free reign, effectively, to then go and build out any technology they want to at their own cost, at their own speed, without suffering the high cost of operating on main chain, but still having that same assurance of trust that you get from the layer 1. So really exciting for developers and people who have an idea and something they want to build that they want to run faster than layer 1. And in other protocols, you've seen that explode into really like attracting a whole load of wealth and really effective use of the tech. And there's no reason to suspect that Cardano will be any different. And And yeah, so Hydra heads will be an exciting thing. We don't know what they're going to look like yet. The demo one is very rudimentary, doesn't really do anything useful. But it's just now it's available for people to go out and use. So just like we saw at the launch of smart contracts on Cardano, you don't expect to see. I mean, the news at the moment is like Cardano's going to explode. It's going everywhere. But you know, be tempered with it because there's no new functionality.
Question for you. Sorry. Right?
Okay.
Can I just is it similar to, if we say the general blockchain is kind of like how, you know, you had an Excel spreadsheet or a program that had to do a lot of calculations before, and then the big thing, like in the, you know, well, what was it, probably the 80s, was putting in a math coprocessor on a machine to help speed everything up. So it was an add-on kind of that helped speed things up, and then it would spit things back into the program. So is that kind of what you're sort of kind of an add-on type of thing in the crypto world?
Yeah, very good. Yeah.
Okay.
So if you imagine like on the current layer 1, the only way you can speed it up really is you've got these 3,000 node operators, stake pool operators. The only way to really speed up the transaction between them is to increase the power on each of those nodes. So you might throw in more processors, more RAM, and that'll get you the ability to handle more transactions and do things a bit faster. And you need to change the parameters on all those at the same time. But instead of doing that, what we get, which you'd call vertical scaling, instead of that, we go to horizontal scaling, where we say, okay, we're going to take this new functionality that's going to need to do 50% of the transactions that we normally see on Cardano. Instead of paying for those 50% of transactions, which could be, you know, millions of pounds, let's go and build our own Hydra head, run those operations in our own environment, and bring them back to consensus with the main chain for, you know, dirt cheap. So yeah, you then got horizontal scaling. So you can have, you know, any big tech that's running transactions in any way, you could build out replicas of those on Hydra heads and have them all come back to reach consensus on the main chain. Really good stuff.
Fantastic, Jonathan. Thank you very much. I think, would I be correct in saying, to translating it in a non-technical way, is that this is the kind of like technology that will then make a difference between having hundreds of thousands of transactions to billions of transactions. And this is what will allow then mass participation in blockchain. And it's just, obviously, it's not just in Cardano, but we got, ZK zero knowledge technology as well in Ethereum and in other blockchains. But this is kind of like exciting for the whole industry, all these new layer 2 technologies, because, you know, we'll need, as we go from 300, 400, 500 million to 4, 5, 6 billion of users, and you can imagine that's an exponential growth in number of transactions. You need a substantially better technology than we have right now. Otherwise, we would have what happened to Ethereum in the last couple of years, where it was pretty much like, you know, it was blocked and nothing could happen because transaction fees were costing hundreds of dollars, you know, simply because there weren't enough, you know, it wasn't fast enough to create enough space to then store transactions. And this is exciting for that, because I think, well, we are now ready to get a financial system on the blockchain. We need this sort of technology, you know, whether it's Bitcoin Lightning, whether it's Ethereum layer 2 technology, whether it's Cardano Hydra. We need this technology to be able to move on to the next level. So it's great to have in Cardano, because on top of the speed, because over here we're talking about the two things, basic speed and cost. So everything has got cheaper and everything is faster. But at the same time, the really exciting things in Cardano is that connected to this thing, you also have the security, you know, which is, you know, higher by design, by fundamental design, by using a really hard to use programming language, for example, that allows you to do things that the Ethereum programming doesn't allow you to do. You know, so all these kind of things actually mount together, and eventually you realize, once, you know, at the moment, what we've had in the first 10 years of our progress, we've had nerds building blockchain programs. Now, what we're having is that we have kind of like real normal people coming in and saying, okay, can I use this for that? okay, if I want to use it for banking, I need A, B, C, D, E, F, G. Can this technology do all these things or not? And the response is that up to recently was no, it can't. Okay, now with all these additions, we are getting to the point where we're saying, yes, we can do them. And not only that, but we can do them with the same level of safety or better, and with a much lower cost and much faster speed. So if we can add all these things up, then this is why you get Visa and MasterCard and the banking industry using some of this technology already, because all people sending remittances from the US to whatever, El Salvador or Africa or wherever else their family lives, because it costs them cents instead of paying 5, 6, 7% to to just transfer some money to somebody else. And that's the exciting part. And just think about it. On top of that, this will also mean that anybody with a mobile phone will be able to be part of the financial system. And there is a big chunk, over 3 billion people that are excluded from the fund, from having a bank account or a financial system. This will give them access to that. This is what it really means. Okay. Okay, do we have any questions? So I don't know what Netflix has got to do with it, Paul. So I missed something. in terms of, say, Pierre, say if it drops, if the market drops, can we expect that to happen in cryptocurrency? Absolutely, absolutely. We're not an island. The only thing would be is a matter of trust. What Bitcoin in particular offers and what is known for is a trustless system. So if there is a problem of trust, like people don't trust the banking system, they might move to Bitcoin and then as a result to cryptocurrency because of that. It's not because they see as a fantastic investment right now, because when things are going down, people don't really look at investment. They think they look at protecting what they have. Okay, so if if there are particular things that are happening that threaten the status quo, then Bitcoin could benefit from that. But if it's just a normal economic reaction, like everything is going down at the same time, with nothing in particular breaking or collapsing, then that would affect cryptocurrency as much as stocks and shares and and other. We can see we've seen it yesterday. What was announced yesterday? What was it? Let's go and have a look at it. You see, we have this core PPI, okay, and PPI being announced. So this is basically the producer price inflation. Okay, so it's not doesn't move the markets as much as the CPI. Okay, but the thing is that it's still moving, it's still positive. So it seems to be quite resilient. Okay, so what difference does it make? So seeing that it is still going up. It's just that it changes the expectations about when the Fed would start, for example, cutting interest rates. And although there is now an expectation that at the next meeting the interest rates will not move, what is happening is that the expectations are slightly changing. Okay, so the expectations for inflations are that it's going to be sticky. Okay, so it's going to be difficult to bring it back. I know it's been coming down, but it's going to reach a level which is going to be difficult to go beyond. And that will mean that these kind of high interest rates are probably going to go on for longer than the market expected before. So what happened yesterday, for example, a lot of things actually went down, including including kind of like commodities and oil, gold, and et cetera, because it expected that there's going to be a more prolonged recessionary period. Whatever you call it technically, is not going to be a good period for the economy, and that now the expectation are that it's going to last longer than they thought originally. Okay. All right. Bridging between ecosystems in the future. Are you talking about between cryptocurrency?
With Hydra, the potential's obviously there as well.
Well, yeah, obviously, Jonathan, because it's also they can run almost like side chains as well in Hydra.
Yeah, so you've already got so this again, it's slightly technical, but there's already an existing sidechain in Cardano, and that was built by community project, and that is the Milkometer, and that's been built to run on the Ethereum virtual machine to interoperate with other with the Ethereum blockchain. So you've got this ability to have tokens move between chains, to have transactions happening within this little side chain Milkometer that then finalize either on Ethereum or on Cardano, and that's a sort of technology that other Hydra heads can have as well. But yeah, the whole interoperability is part of the equation, but really Hydras are about scalability. So just being able to grow massively, and that's one of the legs of the trifecta to make a perfect blockchain: security, stability, and decentralization.
Yeah.
So, yeah.
Again, guys, if you want to have this more in detail, Jonathan will probably talk about it later in his session. Okay, so don't forget to post the link, Jonathan. And I will recommend to anybody that hasn't been before to one of your sessions also to make it a regular thing on a Friday. So you come and listen to this first, then you're going to make yourself a cup of tea, and then you're ready for Jonathan's session as well. Okay, so we got to 9 o'clock now, so we're going to close this call. Again, remember, channel. Tamzin, I haven't personally had time to look at that yet. But the one thing I wanted to leave you with, whenever there's one thing I can tell you all right now. Okay, don't really look at new projects until things are kind of like change, until the wind changes. Forget about new projects. This is what my heartfelt opinion. Okay, because the reason is, generally speaking, genuine new projects would not tend to launch in a bear cycle, in a bear market. Okay, and generally speaking, when a project launches is overpriced because there is a lot of hype. So if a project launches in a bear market, it either means that they are desperate for money, okay, or that it's a scam. I'm not saying it's a scam in this case, okay, but they say generally speaking, because they want your money anyway. So what's happening in a bear market is that whatever project launches, there is a lot of hype. They will launch at a lot higher price than the project itself is worth. But you're going to be left holding the can. So when the market starts pumping and everything is positive, there's a lot of new money coming into crypto, you can launch pretty much anything and make money on it. Okay, but at the moment, it is quite difficult to actually make money on a new project. Okay, because there isn't a lot of new liquidity. So who is supposed to buy these things? Whatever the project is. I'm not looking at any project in particular, but this is new money that invests in any new project. If at the moment the actual the number of transactions are going down, and the crypto prices are going down, generally speaking, you will not want to put new money into new projects. Okay, so for me, it's an elevated, looking at new projects right now, it's an elevated risk that doesn't have a high payout as a reward. So there's no reason for me to take any extra risks because the rewards are just not there at the moment. Once the market starts picking up and starts growing again, then yes, fine, we can look at new projects as well, but not at the moment. And also because the crypto projects are actually expensive to run. Okay, so that's another reason why a project will come to the market, is because they need money to pay the development, to pay the developers, etc., etc. So again, are you investing in a project that is, at its last, on its last legs, and needs money to survive, you know, and then maybe, yes, you give them enough money now, and then within a few months they run out of money and they are struggling again. So these are all, for me, extra risks that at the moment are not worth taking. But, you know, you make your own decisions and you have a look. But I'm saying at the moment, I'm just not looking at new projects really until the market turns. Okay, so with that, I will bid you to have a lovely weekend. Enjoy. Hopefully we get some nice weather. It's quite warm here in the UK. I mean, for the UK, I'm talking about. Okay, so we're still in the kind of like between 10 and 20. So, but for us, it's kind of like really warm. All right. So this is for you that live on the other side of the world. Just understand what warm means to us. In case you come and visit, people tell you, yes, it's beautiful, and then you come in and think, well, actually, I needed a coat. But this is why you see people here in t-shirts when it's like about 12 degrees, and you understand why, because the rest of the time it's kind of like rainy and horrible and cold. And so as soon as a little bit of sun comes out, everybody goes crazy. Okay, anyway, enjoy the weekend, and I'll see you again next week. Okay,
Thanks, Luca.
bye everyone. Bye.